Hey everyone, Aaron Filbeck, Global Head of Content for CAIA Association. We're going to have a conversation today on geopolitics, which is incredibly relevant given some of the market backdrop that we've had over the past couple of weeks. I am pleased to be joined by Marko Papic, who's with BCA Research, and importantly, a co-host of Geopolitical Cousins, which is my new favorite podcast. So excited to have you on with this conversation, Marko.
Well, thank you so much, Aaron, and thank you for the shout out for the podcast. It's a pleasure. I guess everybody at some point in their life has to start one. So there you go.
Absolutely. Marko, before we get into questions, maybe just give a little bit of your background and your history.
Sure. So I started my career in political risk consulting, sort of the run of the mill, what's going to happen and using scenario analysis. And then I realized that I didn't really much like that industry. Everybody seems to always be right all the time. My favorite example to go with is somebody would forecast that Turkey would experience volatility, and then everything from a coup d'etat to like the deputy finance minister resigning would be seen as a correct forecast. So what I really enjoy about finance is that if you're right, but you also know if you're wrong. And I don't mind being wrong. I just want to know which is it. And so I crossed over to finance. On the sell side, worked at BCA Research and developed a framework for investors to incorporate politics and geopolitics, mostly in the public markets. Spent 5 years on the buy side, mostly in alts, which is where the CAIA relevance, I think, comes in. And then I realized, this framework is not just for public markets and just for generating alpha. It's also useful for generating longer-term forecasts and allowing private market investors to avoid some of the pitfalls, especially given illiquidity issues.
Great. Yeah, we'll definitely come back to the CAIA involvement. Marko was one of our authors on our level 2 curriculum, talking about geopolitics from an allocator's perspective. So lots to talk about from that perspective. But Marko, why don't we start with the headline conversation, then we'll get into some of the frameworks, which I think will be really relevant here. But tariffs are back on the table. Over the past couple of weeks, there's been some escalation from a tariff perspective. And when I was listening to one of your conversations when you were talking about tariffs on your podcast, you made the comment that tariffs are actually can be a positive thing. They can be a useful tool from a geopolitical perspective, from a policy perspective, which I think for me challenged some of my own thinking. When I typically hear the term tariff or someone implementing tariff, my reaction is usually negative. But I'd love for you to talk a little bit about how tariffs can actually be used for different purposes and whether or not we're seeing tariffs today being used for positive or for negative purposes.
Well, tariff, like anything else, is really neutral. It's just a tool. And of course, as all tools, it can be used for good and for evil. And so I think that there are various reasons why I think a country would decide to implement tariffs. One is to support a nascent industry where one doesn't even exist. Take, for example, Indonesia. Indonesia digs nickel out of the ground and sends the ore to China. And in order to develop beyond its current level of economic development, Indonesia decided to implement tariffs, export tariff actually, to raise prices of ore. So not an import tariff, but an export tariff, so that China would have to actually move some of its refining to Indonesia. This is, I think, overall seen as generally speaking, a positive way to do economic development. Ultimately, China didn't have a problem in moving its refining infrastructure to Indonesia because they don't really want that kind of dirty, polluting industry in China anyways. Similarly, an advanced economy may decide that certain critical materials or goods are important for national security. And this is where, for example, steel tariffs are not necessarily, I think, as negative as many in the media make them. I mean, you should retain the capability, the ability to produce steel. It's sort of a basic reality in case of war starts. So that does, to an extent, make sense. And then, of course, the pandemic produced similar views of pharmaceuticals. And I think semiconductors as well, from a perspective that, semiconductors are so important for the modern economy. So there are various sectoral tariffs that the Trump administration is implementing that, quite frankly, the Biden administration did as well. And I think that the rest of the world would largely be okay with the US implementing those, just as it is often okay with the rest of the world, particularly developed markets, using tariffs to create new domestic industries. The problem, of course, the downside is that if you take this too far, it leads to technological impairment. Protecting domestic industries leads to those industries basically not being competitive. And then you essentially become addicted to tariffs protecting those industries.
Got it. Got it. Very helpful. Just to understand that, framing this as a neutral thing, I think is really helpful because again, when I hear those terms, and I think when a lot of investors hear those terms, there's a negativity associated with it. So thinking through that as a tool is definitely a better way to think about it. So now that we've gotten the headline conversation out of the way, I'd love to talk a little bit about frameworks, and this is where some of the stuff you've written in both your book, but also in the CAIA curriculum, I think really comes into play. And there's a bit of timeliness to this, but also just more broadly thinking through asset allocation and how do I kind of put together a portfolio in an environment that looks very different today than maybe the past 40 years. So I want to back up, talk about three in particular, and I'd love for you to spend a little bit of time defining a few things and then maybe talking about the application to today. So we'll talk about macro, we'll talk about geopolitical alpha and beta, and then this concept that you've talked about of possibility versus probability, which I think is pretty unique. So if we start with macro, you wrote about this in the level 2 curriculum, this 3x3 matrix of the future state of the world, which will flash up on the screen as I'm talking about it. But basically, for people who are watching, this covers the global distribution of political power and the domestic political system and kind of a matrix. So my question for you, Marko, is as you think about this matrix of 3x3, where were we and where do you see us going on that matrix into the 2020s?
Well, I would argue that we were in the kind of a world that allowed investors to completely ignore politics and geopolitics. So on the domestic political scene, we were in a world of laissez-faire capitalism. So this really emerged in the 1980s, the Margaret Thatcher and Ronald Reagan revolutions, which were revolts. They were true revolutions against the status quo, which in the 1970s, of course, produced quite suboptimal macroeconomic outcomes. If I were to use sort of a very learned academic phrases, what I really mean is that it produced a highly inflationary, stagflationary environment of the 1970s. And so one of the revolutionary sort of moves was to get the government out of capitalism, out of the economy, minimize its role. That's where laissez-faire comes from. It's this concept of let it be, let the free markets just unleash themselves. And of course, that allowed investors to generally ignore, fiscal policy. We became sort of like a crab with like a giant claw, when it came to monetary policy, but fiscal policy was a tiny little claw because we didn't need to really think about it. Everything came down to the Fed. You suddenly had this explosion of the population of Fed watchers because that became the only way to add some sort of knowledge to the policy realm. And fiscal policy effectively became counter-cyclical. It was never used in pro-cyclical way. So that's very, very, I don't want to say positive for investors, although there are certain positive aspects to it. For example, inflation becomes moderated. It does not become very volatile. And growth also moderates as well because the government does not choose winners and losers willy-nilly. The second one, of course, in the geopolitical and the broader sort of sphere is very similar. Again, we were very lucky as investors, if you will, in that it was a unipolar world. The distribution of power clearly favored the United States. Now, I don't think that happened as early as laissez-faire liberalism impacting domestic politics. It took a little bit of a while, probably 85, 86, 87 was really the end of the Cold War. And then, of course, Soviet Union collapses. And then from 1990 until sometimes in the 2010s, the US was clearly the hegemon. And clearly, you did not have to really care about, things like what Russia or China are going to do here, there, or anywhere. So we were there for about 40 years, and it created an epistemic shock to our community. It allowed us to over-professionalize. So instead of having a very holistic, broad education, as investors have had in the past, there were folks who knew history or who knew geopolitics or knew international relations, or hell, even like art history, things like that. That became less relevant. And what we did is we overstaffed our, I think, epistemic community with quants and MBAs. And I think that we are woefully underprepared right now in terms of at least the intellectual capital that we have to deal with this new world. Where is this new world headed? Well, I think you can obviously guess away from these two ideal macro contexts. I think that we're going to see more and more of dirigist capitalism, where the government is involved, perhaps even populist, where it's overwhelmingly involved. And then, of course, on the other side, we are in a multipolar world today, high conviction view from my end, but it could actually become quite pernicious, where it becomes bipolar, where the world is bifurcated between two warring, camps, if you will. I don't think we're going to go there, but the best we can hope for, I think, at this point is moving towards dirigism and multipolarity.
So I want to pick up on something you just mentioned, because I think that's really interesting, the over professionalizing. And if I'm sitting in an investment professional seat today, obviously there's maybe the gut reaction is like, well, oh my gosh, I've got to prepare myself. How do I prepare myself? How do I kind of think differently when I'm looking forward? And I guess maybe I can't go back and get a history degree, or I can't go back and learn history in undergrad all over again. But are there things that I can do to challenge my thinking, approach this world a little bit differently, just given the radical shift that we've had over the past couple of years?
Aaron, one thing that I have a high conviction view on is you can't use AI to tool up. Let me put that very clearly right now. That's not going to help us with this particular issue. It might help with other issues. In fact, AI may very well allow you to have more time to spend on qualitative issues, because your quantitative time spent on quantitative matters may decline. So that's helpful. But from how do you tool up? I think you need a framework. So no, you shouldn't just read history books about World War II or the 19th century. But I think understanding that ultimately policymakers are bound by material constraints, and therefore understanding those constraints is a shortcut to thinking about scenario analysis. I think that that's good enough. And the good news about our human capital in our community, in our epistemic community, the good news is that we're very objective, data-driven, empirical. And so we're actually terrible at figuring out what the preferences of politicians are. We're terrible at it. We're terrible putting it into historical context. As an intellectual community, we just don't have any of that. We have no idea what Trump or Putin want or don't want, or why, or whatever, and that's fine. My message to investors is, don't worry about it. Don't read history books. Actually, what you should do is you should over-index on the real world that bounds politicians and policymakers in terms of what they can and cannot do. So whether it's the bond yields in terms of fiscal policy, whether that is military capability in terms of offensive operations, whether that is the political context, voters, what do they want, what do they not want, polls, we can actually use data, hard data, to create a relief, a view of where the world is going, without trying to become suddenly these qualitative, art historians.
And maybe a question related to that. So, and you've written about this as well, of, there's the financial metrics that are out there. So you mentioned bond yields, inflation, GDP growth. Then there's all this other non-finance stuff that factors in. So how do I think about this today? Whereas I think maybe to try to bring back what you said before, where geopolitics didn't really matter over the past 40 years, we were much more focused on maybe the financial side of things relative to some of the other things. What are some of those other things that I should focus on and perhaps, to use your word, over-index when I'm making decisions?
Well, I think that, first of all, identifying the issues that matter to the median voter is the best thing that investors can do. Now, median voter theory is sort of discredited in political science academic community. it's not seen as necessarily helpful in forecasting where the world is going. I disagree. I think politicians are quite attuned to what the median voter wants. And by the way, median voters, of course, is a theoretical concept, but it's an important one to glean. And there's really two things that every politician has to do in order to get reelected, or in the case of an authoritarian regime, to stay in power. They have to both identify which issues are the most important issues of the day, and where is the median voter, which means where is the largest group of voters under the curve on that issue. So take, for example, the 2024 election. In the 2024 election, I think it's pretty clear, everybody agrees, and I have wealth of empirical data to prove it, that clearly inflation was the most important issue du jour, and that the median voter clearly had a quite, I would say, center-right, almost conservative view on that inflation. In other words, we need to kind of rein this in. No more, no more wanton fiscal spending. And this is important because it tells me also where over the next 12 months policy is going to have to go. President Trump in 2024, 2025 cannot do what President Trump in 2016, 17 did. In 2017, we had this very freewheeling, unfunded, pro-cyclical fiscal stimulus in the form of 2017 tax cuts. This time around, it's going to have to be bound. It's going to have some spending cuts to pay for it. And it's going to be very difficult to spend as much as both the Biden and the Trump 1.0 administrations did. Why? Again, because voters don't really want it. Similarly, tariffs, the policy that everybody wants us to talk about. Of course, Aaron, you were very generous at the beginning. You said we handled it. Oh boy, did we not handle it. There are going to be so many questions. But one of the things is, in 2024, with the median voter being as focused on the issue of inflation, I think it's going to be very difficult for President Trump to justify a calamitous recession and potentially even stagflationary outcome, because I can tell you nobody really wants a trade war. I know it sounds hyperbolic. I know a lot of your viewers are going to shake their fists at me, but the polls are clear. The number one issue in America is inflation. The last issue in every single poll is trade, tariffs, and globalization. It's just not as much of a winning political issue as it was in 2016. And so, yes, this framework would tell me that where the policies are going to head over the next 12 months. A retrenchment on the most, aggressive tariff policies. I think there's going to have to be retrenchment. In other words, I think Trump will favor deals and negotiations over a permanent higher price regime. And then on fiscal policy, I think that investors should not hope for the fiscal engine of the U.S. to continue to power the economy.
I want to come back to fiscal because I think that's another interesting topic that we should cover. But I think a lot of what you're talking about leads into this probability versus possibility, and you've written about this and spoken about this. What does that mean? And how do I think in probabilities instead of possibilities, especially when things are chaotic?
Well, I think this is the most important thing. When things are chaotic, the realm of the possible expands. It is possible that President Putin will use tactical nuclear weapons to conquer parts of Ukraine that he has massively failed to conquer. That was literally something that very serious people were discussing and writing op-eds about in serious publications in March, April, and May of 2022. This was the issue of the moment. So the realm of the possible expands massively, but the realm of the possible is not bound by constraints. So I'm 6'1", between 195 and 210 pounds, depending on, travel and, where I'm traveling.
And what the tariff levels are.
The tariff levels, yes. If I can get my Icelandic high protein quantity yogurt or not. Which soon I won't be able to get, I suppose. But the point is, I'm 6'1", about 195, 200, 43 years old with 3 kids. Could I dunk? Is it possible that I get back to the fitness level of a 23-year-old and dunk the basketball? The answer is yes. It is in the realm of the possible. But if you knew the constraints that I face, you will be able to assign scenarios and probabilities to different outcomes. One, Marko can dunk with two hands off of two legs off of a standing position. Probability 0.1%. Marko can dunk while running with one hand barely. Probability 0.2%. And then final scenario, Marko will never, ever be able to dunk because it's too late for him, 99.7%. That is the difference between the possible and the probable. And the problem is that most of the time, investors assign, especially as you said, in the moment of sort of panic, the realm of the possible expands, in part because the media and journalists, and God bless them, nothing against them, but they do kind of make money off of your clicks. And so they have to convince you that, yes, the realm of the possible expands. In fact, they will favor interviews and they will reach out to experts who actually discuss these quite unlikely outcomes, because that is where you will absolutely click. You're not going to click on a headline that says President Putin bound by material constraints, likely to end up in a bogged down war in Donetsk. You will click on tactical nuclear weapons are likely to be used in Ukraine. And that's where I think that a constraint-based framework and focusing on what is probable, not possible, is really important for investors, particularly those in the public markets, I would say, who are trying to generate alpha off of the bidding up of risks and panic and so on.
Well, I didn't realize we were going to get into your fitness regimen or your ability to dunk a basketball. That's great. Lack of, yeah. No, that's great. On that theme though, if you could point to like one or two things that are the most out of whack, the biggest delta of the material world versus kind of the hyperbolic nature of what's going on in markets, where is that biggest delta today?
Well, I would say that it's not really about my view of probabilities. It's probabilities combined with valuations. So that is a really important way for investors to think about it. We can sit here and say that, Canada is not going to become the 51st state of the United States of America. That's true, but there's nothing that's been priced in the markets to justify us really even talking about that. So the two things I would bring up that I think are interesting, first and foremost, this notion that Europe will be a museum, that it will deindustrialize because of high energy costs. I think that that is driven mostly by the media. Some sophisticated media behind that narrative, and that narrative is just wrong. It's perhaps in the realm of the possible, but not the probable. First of all, a cure for high energy prices are high energy prices. This has always been the case. And so that's the first issue. Europe is about to be drowned in a tsunami wave of LNG, in part because prices went up. So supply is coming online very, very fast before demand can catch up. The second issue is that Europe never benefited from cheap natural gas from Russia anyways. This is one of the most ludicrous notions I've heard over my career, and creates incredible long-term investment opportunities for investors. The notion that Russia somehow supplied Europe with cheap gas suggests that Russians are nice when it comes to negotiating. And by the way, I don't mean this negatively. God bless them. They were trying to get the highest price they can. Anyone who even has a modicum of understanding of Gazprom Commission negotiations knows that Gazprom kept those natural gas prices linked to oil prices for a very long time. So that's one example of this. The second one would, I think, be President Trump's tariff policies. Is it possible that President Trump wants us to go back to 1901, the glory years of President McKinley, when we financed the entire government with tariffs? And yeah, sure, it's possible. Just like, I may yank it down from standing position with two hands. It is possible, but it is improbable. First of all, U.S. government as percent of GDP was 2% in 1901. It is now 30%. In other words, you and I, Aaron, could have financed the U.S. government with a bake sale in 1901. And so, yes, tariffs were a tool of raising revenue. Now, I don't mean that President Trump doesn't mean to raise any revenue from tariffs, certainly some, but neo-McKinleyism is unlikely the trajectory of where we're headed because of a slew of constraints that create alternative probabilities. And that's where I would sort of temper some of the most bearish views of the tariff war and deglobalization narrative. I think there's going to be some of it, but I think it has to be scenario game planned, and we come to a different outcome. when we do that.
You're gearing me up for my fiscal question, but before we get to that, third category is this geopolitical alpha versus beta. Just I think if you could explain the difference between the two, and in particular, given our audience is much more focused on private markets, where does private markets play in that trade-off between alpha and beta?
Yeah, so I wrote a book titled Geopolitical Alpha, and it was sort of a bookend to my experience of being on the sell side, mainly working with public market investors. And so I was hyper focused on how to generate alpha. And the way to do that, in my view, is to basically not try to predict events from happening, but rather to fade them once they do. Because there's a dislocation in the markets, I think, because of a particular moment in history that we exist in, where our epistemic community is over professionalized on the quantitative and macroeconomic side. We tend to overreact to events and start pricing in the possible, not the probable. And so what I like to do is generate alpha by fading geopolitics. And most of my clients, it takes them time to get used to this because I'm like the geopolitics guy in the markets. And so they wheel me out in the office and they expect me to say, buy gold and guns and ammo and maybe sardines and so on. And I'm quite often very bullish because the event has already occurred. And once the event occurs, the market starts to price in way too much risk. And so 9 out of 10 times, the way to generate that alpha is to fade this. That said, for private market investors, there is no such luxury because, of course, there's an illiquidity concern. And so for private market investors, it's really about thinking about the long term. And in the long term, well, first of all, before we go to how to do that, I think what's interesting, Aaron, is how you would have thought that given the paucity of implications for the markets from geopolitics in the short term, that public market investors would be less concerned about it, and that the private market investors would be far more concerned about it because of the illiquidity premium. But it's actually the opposite. It's the shorter term investors, macro hedge funds as an example, event-driven hedge funds, allocators who actually care about politics and geopolitics to an extent, I would argue, too much. And what I've noticed in my career, at least, is that the private market investors are almost completely aloof of politics and geopolitics, even though it's politics and geopolitics that creates the long-term conditions for technological innovation, for growth, and for, I think, long-term locked-up opportunities. And so that's what we call geopolitical beta. It's this idea that you want to invest in those technologies, companies, geographies, countries, and sectors where the second derivative or the second order effects are going to be positive, not those where the first order effects are positive. That's already in the price, and you're probably the last dollar in that.
So here's the fiscal question that we've been gearing up for the past 5 minutes or so. But fiscal stimulus, fiscal policy, at least the way that I understand it, and you can correct me if I'm wrong, but there's a bit of a short-termism to some of these policies with potential bump that comes in growth, potentially inflation, depending on what type of fiscal policy takes place, and then it corrects later on. So if I'm a long-term investor that is in the private markets, I'm locking up my capital, how do I even factor in something like fiscal policy into a portfolio decision? How do I play offense? How do I play defense? Or does it not really matter over a longer term period?
No, I do think it matters. And it matters because fiscal policy can often hide actual, problems and warts. And so I would argue that many investors have become extremely enamored with the argument that U.S. is exceptional. And there are things that make U.S. truly exceptional, particularly the venture, for example, ecosystem. In many ways, exactly the kind of things that fall in private markets is exceptional about the U.S. But I would argue that since 2020, U.S. growth in particular has been fueled by fiscal policy. And I would be quite hyperbolic about that. The U.S. spent 4 times more than Europe since 2020 in terms of fiscal outlays. That is an extraordinarily large amount for two economies that are roughly the same size. I mean, obviously the EU versus the US. So, 4x more fiscal outlays in the US. And these have obviously produced impacts on earnings, on revenues, on multiples of public markets, but also on capital flowing to the US for various private endeavors as well, whether it's venture ecosystem or whether it's, I don't know, like private credit, which is almost exclusively an American story today. And so I think that if you are managing private assets or you're an allocator, deciding where those alternative investments go geographically, I think you have to be aware of where fiscal policy is probably coming to an end due to the bond market reaction and where it's not coming to an end, where it's perhaps at the beginning. You want to know where your dollar goes and gets locked up at what valuation. And that's where I would say fiscal policy really matters. Those decisions have to be made. And so if you're looking at US versus Europe, I think almost in any alternative investment class, I would favor Europe over the US. Not all, but I think almost any, I would favor Europe just because there's just been less private market dollars that have gone there, or euros. And Europe is at the beginning of its upswing in fiscal policy, and the US is at the beginning of its downswing.
Do you think that there is still room to run in the US in terms of fiscal stimulus? I mean, 4 times as much as Europe. And I know we're not talking about other parts of the world, but I guess maybe that's one question. But two, the second part of that question is, where in the world has the biggest kind of fiscal stimulus opportunity moving forward?
Well, I would be careful, not to over stress this, Aaron, because I don't want our viewers to think that you want to only invest based on fiscal policy. For sure, that would be a wrong lesson. But to answer your question, just very, very bluntly, no. Like heck no. And I know this is a family-friendly show, so I'm trying to not use any stronger language here. But no, the U.S. has no more room for fiscal policy. I do think Congress will obviously pass the extension of the 2017 tax cut. That alone will cost $4.7 trillion over the next 10 years and will add absolutely no growth to the United States of America. Remember, extending the 2017 tax cuts means that your taxes remain the same. There's no impact. It costs $5 trillion, but it has no impact on actual humans and corporates in America doing human and corporate things. Zero impact. It's as Secretary of Treasury Scott Bessent said, it's a must do. Otherwise, we will have obviously the largest tax increase in U.S. history. It costs $5 trillion to do, but it will not have any impact on actual investors. Whereas if you look at China, Chinese long-term bond yields are below 2%. I mean, for good reason. They're mired in a secular stagnation and a post-real estate crisis, obviously. So that's why their bond yields are low. But at the same time, that suggests that they can spend more money domestically. And then the EU aggregate bond yield is closer to Germany's rate, not that of Italy or France. So you're looking at somewhere around 3%. EU is likely going to be pushed to issue joint issuance. Why? Because obviously trade war is seen as exogenous risk, as a pandemic, as an alien invasion. So they have an excuse to do more of this. So I would say that those two economies are going to see more fiscal. Now, again, caveat, very important. Fiscal policy without structural reforms does not create interesting entry points for long-term, locked up, illiquid investments. So am I going to invest in China or Europe just based on this? No. What I want to see is actual structural reforms. In China's case, it means more pro-business, less, completely arbitrary sectoral regulatory actions. And in Europe, it means more integration. The single market is a single market in Europe only for goods. It's not really for services. And I think that over the next 5 years, investors are going to have an incredible opportunity in roll-ups and buyouts in Europe, particularly as some of these barriers to trade internally in services start to be broken down. And I'm very excited about that move in Europe.
Yeah, and I think that whole point on, it's a must do because it's a tax raise here in the States. I mean, that whole, markets don't react to the level. It's more about the change, and then there's no real change from that perspective. It's more of a continuation of what already exists. So Marco, maybe final question for you, and I know it's always dangerous to extrapolate the past into the future, but is there any historical context or analogs that we can pull from to help us think about looking forward or not?
Yeah, so I think, going back to the 3 by 3 that you flashed earlier, I think that was very nice, and I think that's a really interesting way to think about the world. Now, most of us, for the most part, we have modern analogs to laissez-faire capitalism, to dirigist capitalism, to populism. We can point to countries in the world that have tried out all three. We know what the implications are, more or less, for growth, inflation, innovation, ease of doing business, and so on. On the geopolitical side, all of us have experienced the Cold War. Maybe only the youngest of millennials have not, but for the most part, every generation that's currently investing has experienced the bifurcated world. And we've also experienced sort of unipolar world under US hegemony. I think the most difficult analog, Aaron, to really wrap our mind around is a multipolar geopolitical environment. And I think a lot of investors fear it greatly. First of all, there's home bias. If the US is no longer the hegemon, I think a lot of investors who watch this, who are based in the US or are Americans themselves, may say, well, that's not a great world. But what I would actually say is that if you read the history of the concert of Europe, the long peace from 1812 to 1914, there was a lot of conflict, a lot of military armed confrontations, really all over the place. But there was no world war for many reasons that we don't have to get into, but it's important, until 1914. And the second issue is that there's an incredible amount of innovation. I mean, literally everything we have invented that matters to us as humans was actually invented in that kind of like 1830 to 1914 period of time, other than obviously electronics, computers, and all that stuff. That's awesome. And obviously we wouldn't be able to do this otherwise. But if you think about healthcare, transportation, industry, materials, there was just an incredible amount of technological innovation, in part because countries were competitive against one another, in part because the government did get involved in some of that, industrial protection, but also innovation and financing R&D. And so I would say that if you're a private investor right now, particularly in venture and technology, I do think that you should be a little bit more optimistic. I know that obviously the venture community has been in a lot of pain since 2021. And I would also say that the venture community probably is not adept at investing in this world, because I think a vast majority of them are focused on SaaS as a business model and software. But I do think that when you start thinking about technological innovation, the next 20 years are probably going to be very good. They're just going to be more in hard tech and the things that kind of matter beyond software. And I'm very excited about that. And I think that opportunities there are going to be very interesting, probably led by, negative factors such as military competition and competition between states. But nonetheless, the outcome, the byproduct, could be actually pretty beneficial for humanity, despite the origin of the innovation.
Well, Marco, we'll have to leave it there. I really appreciate your time and answering some of my questions. I learned a lot in a very short period of time. For members who are watching this, for the geopolitics readings from Marco in level 2 are available to you. We'll make that available to all the listeners as well. But Marco, keep up the good work and appreciate your partnership with CAIA.
Oh, it's a real pleasure, and it's my favorite partnership. Thank you so much, Aaron.